You're listening to the Big Cast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glenn Sarvati.
Welcome to another edition of the Big Cast. My name is Glenn Sarvati on behalf of the Best Innovation Group, where we like to do cool things with financial technology. And today we've got an interview with Andrew Warren from the Financial Health Network, which has just recently issued a new report offering a fresh perspective on how to really think about the unbanked and underbanked populations, which I think is a very thought-provoking piece of work. So we're going to get into that in just a second. First, I'll remind you can always find out more about the Best Innovation Group by checking out our website, big-fintech.com. We've been talking a lot recently about our recent conversations that took place out in San Francisco at Visa's Market Support Center at CU Unplugged. And we'd love to continue those conversations. And one of the ways we're going to be doing that are regular Innovation Club meetings, which take place on a monthly basis, but meet twice a year in person. One of those in-person meetings is coming up in the Midwest in early to mid-May. Great opportunity to get together with a small roundtable of like-minded individuals who really want to dig into some of the forward-thinking kind of opportunities, challenges, ways to address them in the credit union space. We're always looking for other folks who fit into that conversation. We think we'll take some of the things that kind of came out as top of mind from CU Unplugged and probably drill into that a little bit deeper. The Defense Credit Union Council, who also helped put together the overall CU Unplugged event, I know they're using that same approach and using some of the output to inform their annual conference coming up this summer. But if you're interested, we are always looking for people who would like to get involved in this conversation, and get in touch if you can make it out in mid-May to the Midwest. We have a couple of guest passes to add to people at the table. Would love to talk to you if that sounds of interest. You can always go out to our website. There's a tab for the Innovation Club, and you can find out a little bit more there and express your interest. I'll post into the show notes about it as well. Before we get to our interview, there's a couple of big stories in my mind this week that popped up. Just want to mention really quickly. The Interchange Fee Prohibition Act, the effect in Illinois, that taking effect theoretically on July 1st. I've been skeptical of whether that was going to happen for some time because it's so logistically, I think I'll go as far as to say impossible to pull it off around then, which would exclude or prohibit the assessment of interchange fees on the tax and tip component of any bill that you receive. That is back to being kind of in question because the OCC has come out and announced that they feel that state law would preempt federal regulation and federal banking law, and therefore they have announced their intent to put out, I love this term, this has come up a couple times recently, an interim final rule. Which sounds to me like an oxymoron, but in this case, it's hopefully going to help clarify some situations as well. That same interim final rule approach is being taken, by the way, with the CFPB in terms of dealing with open banking and 1033. But they've been promising that now for some time. Haven't seen it yet, which is kind of odd. This one has a little bit more urgency to it since absent some type of action from somebody. The clock is ticking, folks. We're talking about only a little more than 2 months now before we're going to have to deal with this situation in Illinois. The NCUA, technically credit unions would not be off the hook since the OCC is not the regulatory authority responsible for the credit union side. The NCUA has expressed some receptivity to looking at this as well. So watch this space. It doesn't just affect folks in Illinois. This would be any transactions taking place in Illinois. It would also affect any card issuers involved in Illinois. So a lot of moving parts, a lot of questions of how it's going to be dealt with. I suspect that now, assuming the OCC follows through on this threat to put out an interim final rule, we'll wind up with either more lawsuits that'll slow things down or something else that will wind up pushing out any implementation past July 1. But we cannot count on that. So let's see what happens next. The other big story this week was the controlled release on a relatively quiet basis of the long-promised X Money super app from Elon Musk, basically putting payments capabilities within the X social media app. This, as you know, has been a brainchild and a real pet project of Elon going all the way back before he sold his original company called X to PayPal. And if you remember our prediction game that we played last year at the CU Town Hall, the launch of X Money was one of the things that was on our bingo card. That because, frankly, X Money, Elon had promised X Money last year, which time passed, it did not happen. So I took a wait and see. I'll believe it when I see it approach. Well, it looks like something finally is happening. Right now, as I said, it's a controlled release. He seems to be trying to target the creator economy. It would be a great way, in his view, for people who receive money from X for the number of posts that they're creating content out there for, to actually have a place to have money deposited directly for them and put into a high interest bearing account with rewards on the debit card as well. Ron Shevlin, who puts out a lot of great content, I'm sure you're familiar with him. He wrote an article about this in his ongoing Forbes series, The FinTech Snark Tank. He titled it X Money, How It Could Win and Why It Won't. And I thought this was a little interesting. I'll post a link to that article, which I think, well, okay, here's one of these stories where I think it's really well done. I also happen to agree with almost everything he says. Those two facts may be related, the fact that I think it's such a good article, but that's neither here nor there. It's very well thought out, so I think you'll find it thought-provoking regardless. But he wrote about that and then posted kind of a promo of it both on LinkedIn and X. The LinkedIn post got a lot of traction. The X one has gotten an unbelievably small number of impressions, especially given the footprint and the reach that Ron Shevlin usually has. I can't help but wonder exactly why the X platform isn't necessarily pushing out a post that says that X Money may not be working. Make of that what you will. But anyway, I think Ron's got some great points, and I want to dig into this further. I have not seen the app myself. As I said, it's in controlled release, but I'd love to know more, so we'll be taking a look at that too. The Financial Health Network has a new report out on a topic that I think has been kind of overdue for reconsideration. The unbanked population, which we know has been actually trending in the right direction, and the underbanked population, which is just kind of a more complex thing to think about. So we're going to do some thinking about that here with Andrew Warren. Let's have a listen to my conversation I had with him just recently. I'm here with Andrew Warren, the manager of research for the Financial Health Network, a group that puts out some of my favorite research. And you guys tackled one of my favorite topics with, I think it must be your most recent report. I love it. You call it a brief, even though it's 26 pages. It's just not, I love any organization that can refer to 26 pages as a brief. But anyway, Andrew, thanks for taking the time again.
Yeah, thanks so much for having me, Glenn. And we had maybe more to say on this topic than we originally thought when we set out. So looking forward to chatting about it.
And you had to edit yourselves even then. So the topic is, something that, I think is, always in the airstream with, financial wellness, but, an evolving definition that I guess you guys really felt the need to tackle, which makes sense. The unbanked market and how big that is, and the underbanked market, which is even a fuzzier definition. I guess, I don't know if that's literally when it started, but the first metrics that you show in this report is a statistic from the Federal Reserve and their survey of consumer finance. It goes back to 1989. It looks like the kind of the gold standard on it since then. This is for the unbanked. Was the FDIC kind of taking that over around 2009, which is, an eternity in fintech years. What gave you the impetus to kind of jump into this topic now?
Yeah, so first of all, the unbanked rate has declined really pretty dramatically over the last 35 years since 1989, as you said. We went back and looked and saw that in 1989, around 15% of households were unbanked, meaning they didn't have a checking account or a savings account. And that is down to around 4 or 5% today.
I'd kind of forgotten. I mean, I knew it had gone down, but I did not remember it was as high as, the 15, kind of the mid-teens almost. That's kind of amazing.
Yeah, us neither. I mean, I had never looked back that far in the data, and I actually didn't know that the Survey of Consumer Finances was asking about this that far back. But they did. They asked about it in slightly different terms than the FDIC asked about it today. But roughly speaking, there were quite a few more unbanked households, even just 35 years ago than there are today.
And I guess we can attribute some of that success just to the notion of fintech. I think that if I'm not mistaken, the number of branches in this country maxed out right around that 2008, 2009 range, but that's about the time the iPhone took over and gave people more capabilities to work without branches too. So I don't think your research can necessarily confirm that, but that's just kind of anecdotal connecting of the dots.
Yeah, I think certainly mobile and online bank account access has a uh, huge part to play in that story, as does probably national initiatives to promote financial inclusion. Things like the Bank On initiative, which provided and still does provide low cost, low fee checking accounts to lower income households, made having a checking account more accessible for a lot of people as well.
Yeah, that kind of leads the online piece leads to I think one of your first kind of key takeaways is the definition, as I understand, I was not aware of this, does not really include online only banks, and if we really take that into account, the unbanked rate drops even further.
Yeah, so I think the definition of what it means to be unbanked is really simple. It's just, do you have a bank account or not? But the definition of what a bank account is has become a little fuzzier over time. So, 15 or so years ago, it was pretty straightforward whether someone had a checking account or a savings account. But today you have a whole host of online only fintech platforms that are, in some senses and instances, banks, and in others, not. So you have companies like Chime and Vero and SoFi and MoneyLion, and there's a bunch of others as well. Um, None of these companies have brick and mortar bank branches. Some do have bank charters, so they actually are banks, but others don't. And instead, they are really just fintech platforms that establish a bank account for you on your behalf at another institution, which means that if you open an account with one of these services, your money is in a bank account with FDIC insurance, but you're accessing it via a platform that is not a bank. So that gives us this kind of gray area with these online only platforms. So with that in mind, we decided to ask survey respondents to our financial health pulse, or sorry, financial health spend survey this past year. Survey respondents who said that they didn't have a bank account, we asked them a follow-up question asking them, do you have an online account, one of these places like Chime, SoFi, etc.? And around 1 in 5 unbanked people said that yes, they did have one of these accounts.
So that means
So that just
they don't perceive of that as being a bank. They're self-identifying as unbanked despite the fact that they have an online bank account.
Exactly. There's this kind of set of people out there who don't think of themselves as having a bank account, but they do in fact use one of these platforms that, is either a bank or at the very least does place their money in a bank account somewhere. So that just raises, I think, really interesting questions about, yeah, how people even understand what a bank account is in 2026. And it also raises questions about, if people begin to increasingly leave mainstream banks in favor of online only banks, is that something that we should be concerned about? And I think that that's an important question for the industry and for policymakers and regulators.
So to me, like I said, that was key takeaway or interesting takeaway number one for me. But where to me it gets even more interesting is when we start talking about the underbanked. And that definition's
Right.
been even squishier. And I think the range of the range of outcomes I hear is the estimates, is still pretty wide. You had mentioned, I was not aware of this, that from a legacy standpoint, the FDIC actually identified, was it 6 or 8 products that they considered alternative financial services that kind of recorded their definition?
Yeah, that's right. So, for those of your listeners who aren't familiar with the term, the definition of what it means to be underbanked is people who have, or households who have bank accounts, but who also use alternative financial services. And the way that the FDIC has historically defined alternative financial services is non bank services, including money orders, check cashing, remittances, payday loans, rent to own agreements, pawn loans, tax refund anticipation loans, and auto title loans.
And the idea would be if you have taken advantage of any of those, you become underbanked because the assumption is you're using a suboptimal financing alternative.
Yeah, exactly. And this is the definition that the FDIC settled on about 15 years ago. And I'd say, 15 years ago, again, this list I think made common sense. If you were using one of these financial services outside of a bank or a credit union, if you're going to pawn shops to get credit, or if you're using check cashing services at a corner check casher, those services were likely costing you a lot more than if you were able to get those from a bank. So researchers for a long time used this definition with these 8 products as an indicator that a household's needs were not being fully met by the banking industry.
So, I mean, I guess there's a kind of an assumption there that people, the inference is that if you could have done this at a bank, you would have done it at a bank because it would be a better way of doing it. Whereas, I guess over time, especially as some of these products have evolved, there's probably scenarios where people elect to do some of these things, even though they may have had the ability to do it through a bank. Is that a fair statement?
Yeah, I think it's fair to say that the assumption is, since these services and products are usually more costly or expose you to more risk, there's some sort of barrier to, if you're using these services, you're experiencing some sort of barrier to using these services at a mainstream financial institution, whether it's that you simply don't have the credit score to get cheaper credit from a mainstream financial institution, like in the case of payday loans, or in the case of check cashing services, maybe your bank or credit union just doesn't offer the kind of convenience that you, or the immediacy that you need from the corner check casher.
And, in the meantime, of course, over the last 10, 15 years or so, the number of products that you've identified that, are alternative financial services, and many of them, when you look at them, don't have that same necessarily costly aspect or don't have to, has increased dramatically. Like you mentioned, one piece that I know Chime makes a lot of hay on is the notion of getting paid earlier and the ability for your paycheck to show up sooner. We've seen kind of an increase in early wage access solutions and direct to consumer cash advances based on your paychecks. And those typically don't go through your bank. They often go through your employer. And I guess that's yet another example of, are you necessarily under? And again, the definition as it stands today would not include that. But if you did start looking at a broader list of definitions, that might show up in the mix, right?
Yes, exactly. So that list that I just mentioned is missing several newer products, mostly fintech based products that have, I think over the past 10 years or so, have become really important parts of the consumer financial services landscape. So there's earned wage access, which you were just mentioning, which is essentially a form of credit that uses your future expected earnings to advance cash to you ahead of your next paycheck. But there's also, peer-to-peer wallets, which is the technical term for things like Venmo, PayPal, and Cash App, where people are, storing their money and making transactions. And there's also buy now, pay later, which is, essentially credit offered by a fintech company at the point of sale, often interest free. So there's, just like the question that we were talking about earlier, of, what is a bank account in 2026? There's another big open question for the industry, which is what is an alternative financial service in 2026? Should these products be considered quote unquote alternative, just like payday loans and check cashing services and so on, or are they something else? Should we be considering them mainstream?
And we talked about this a little bit earlier when you and I were trading notes on the topic. The notion of, the current, rigid definition of underbanked. If you literally took all these new products and said that anybody who used them was underbanked, I think, I mean, as you put it, it's kind of like a straw man scenario. It's not anything that anybody would really take seriously, but it would imply that like what, seven to three quarters or something of the population was quote unquote underbanked.
Yeah, exactly. So if you said that, all non-bank services were alternative financial services, at least all the ones that we thought to ask about in our survey, there's, more growing every day. If you did this, you'd get an absurdly high estimate of the population that would be considered underbanked. We said it'd be around 76% of the population. And really all this reflects is that a very large majority of people in the United States are using at least one non-bank financial service. So, for example, something like 72% of households are using peer-to-peer wallets, things like Venmo and Cash App, and 17% have used buy now, pay later services in the past year. So, these things are becoming, when you take them all together, nearly ubiquitous.
Yeah, you have an appendix at the back of this report, and we'll post a link to the report. One of the things that I found the most surprising on that was buy now, pay later. You showed that basically one in every six of your respondents had used a buy now, pay later loan over the course of the last 12 months, which is basically at the same level now as prepaid cards, which I found pretty surprising that it's. I'm not sure if I'm surprised that buy now, pay later is that high or the prepaid cards are that low, but I wouldn't have expected those two to be running neck and neck.
Yeah, it's interesting. It's been increasing over time, and I wouldn't be surprised if the number was higher than 17% next year. If you followed kind of media coverage of buy now pay later, you'd think buy now pay later is taking over the country and everyone
Yeah.
is going to be using it next year. And maybe that's a little bit overblown, but it certainly is growing. And I wouldn't be surprised if it continued to grow.
Yeah, and one of the other things, and I don't know if this is your, the report specific new terminology. I don't remember ever seeing this before, but you had an interesting way of breaking things out that there's actually there's a fork in the road on underbanked, and you could be looking at credit underbanked and transaction underbanked. Was that a new concept that you're introducing here?
Yeah, so I'd say the general thrust of the report is to kind of take apart this question of what it even means to be underbanked in the first place, and see if we can kind of break it apart and come up with some more useful alternative definitions. One of them, like you were just mentioning, is to clarify that there's really two different types of being underbanked. One is um, credit underbanked, which is you're using an alternative financial service that is giving you access to credit that you wouldn't be able to get from a mainstream financial institution.
And that could be a
Um,
payday loan, going back to some of the originals, or it could be some of these early wage access solutions.
exactly. And which of those products you include in that definition really depend on your perspective on, which of these products are posing costs and risks to consumers, right? So, again, like 15 years ago, there's, a little bit more of a consensus that things like, payday loans and pawn loans were suboptimal ways to access credit for a lot of consumers. And so those were signs of risk. But you could argue, that some people argue that earned wage access is equally as risky as payday loans. And there's some research evidence out there that suggests that a lot of people who use earned wage access end up in these kind of debt spirals where they're relying on earned wage access every paycheck to get by over an extended period of time. But then there's also, you could argue that earned wage access is in many cases much cheaper than payday loans. It's a safer alternative, and if used in moderation, it can be very inexpensive. It can be even free if your employer is offering it to you, and they're not charging you a fee for using the service. And the same is true of buy now, pay later as well. There's a way of using buy now, pay later that's very risky and leads to overspending and loan stacking, where you're taking out way too much credit at once. But there's also a way of using buy now, pay later where you're, essentially, maybe financing a vacation interest free, and it's causing you no financial hardship at all. It's really just a useful, inexpensive source of credit. So, we in the report, we explore all of this really just to surface these kinds of what we think are important big questions for the industry and for policymakers. You know, in a world where um, you know fintech services are everywhere, and 95% or more of the country has a bank account. What does it even mean to have financial inclusion as a policy goal? And how do we want to measure our progress towards that goal? Is a measure of the underbanked even useful for us anymore?
Yeah, I mean, I think it's a real, and I guess your goal here, correct me if I'm wrong, is really to start the conversation. I mean, you're not necessarily proposing that you have an answer that this is the way we should do it, but this is something we need to be thinking about and setting, like you say, setting benchmarks for ourselves. Is that the objective?
Yeah, exactly. I mean, I wish we had an alternative definition of unbanked and underbanked, or an alternative measure of financial inclusion that was the silver bullet that we could all use going forward. But I think that's we're going to have to work through that as researchers and as an industry, going forward. We do have some, I would say, general ideas that we offer as food for thought at the end of our report. One of those ideas is, as you mentioned earlier, is um, very simply just splitting the measure of the underbanked into one that's credit underbanked and a definition of transactionally underbanked. So, credit underbanked people would be turning to alternative credit sources because of severe credit access constraints, which, you could really measure separately. And then transactionally underbanked people would be those who are turning to alternative banking services because their bank just isn't offering them convenient access to things like, for example, check cashing services. But a bigger idea that we explore and kind of leave the reader with at the end of the report is that we may need to move beyond these simple measures of who is using what financial services and really work on developing some measures that consider how different services are being used. So, again, like the example of buy now, pay later, the buy now, pay later borrower who's using it to finance a vacation one time is very different, think, qualitatively from the user who's using it weekly to pay for groceries. That latter case is far more concerning from a financial health and risk perspective. So
And I
where
would
to draw the
say,
line on these things is, it's tricky, but I think that's the general direction that we've done.
and I would say that even something with a mainstream as credit cards right now. Obviously, the behavior of a transactor is different than a revolver, and even a revolver. There's good. I think what I'm hearing is everything in moderation, can actually be valuable. But if you start over relying, I've had that same concern that you mentioned, that it sounds great to get early wage access as long as it doesn't just become an expectation and all you've done is moved everything up 3, 4 days every single pay cycle. If obviously there's gonna be times where cash gets tighter and you take care of it, but you just can't let it become the norm, I think is what it comes down to.
Yeah, I think that's exactly right. And I think that it also points to needs for really clear product standards across the industry as well, which I think we're lacking right now, especially on these emerging products. So, when we're looking at earned wage access and buy now, pay later, which features of these products promote financial health and which features harm it? And that's a major focus for the financial health network right now, is establishing kind of industry-wide product standards across both legacy financial products and emerging financial products.
And speaking of which, probably the best opportunity coming up in the next month or so to actually kind of continue this conversation is your annual conference, Emerge, which is taking place here in my backyard in Atlanta, Georgia, May 19th through 21st, I believe, if I'm not mistaken. And that's
Yes, that
so you'll
yes,
you'll
that's
have this report as well as lots of other research. I mean, we'll be obviously there to kind of be further analyzed and discussed by a group of folks.
yeah, absolutely. So yeah, this year's theme of the conference is scaling progress, shaping the future. And it's really all about consumer trust in financial institutions and consumer relationships with financial institutions, and how technology is shaping that relationship. So, exactly, I think it's a great place to continue this conversation There'll be over 450 other senior decision makers across the financial services industry and fintech, policy, nonprofit leaders, researchers, uh, employers represented, and many others as well.
I've
And
been there,
yes, it's May 19th through 21st, and registration is still open, closing soon though on April 24th. So we'll make sure your listeners have a link for that.
yeah, we'll definitely post that. And I've been there before, and I've looked at the agenda. I certainly, I recommend it, and I certainly plan to attend. The other thing I said, nothing, all in moderation. A lot of these solutions make sense, but the other thing is that I feel a little good about is the new products that are on this list. And as we've discussed, you can definitely see a dark side and a bright side to things like buy now, pay later, and earn wage access. But it seems to me that the cost components of most of the new fintech solutions that have popped up are certainly not as onerous as that original, whatever you want to call it, the evil eight or whatever that were in the original definition. So it seems like we're making, progress in the right direction, the same way that the overall unbanked population has gone down. And I've seen this many times in focus groups when we talk about folks from kind of lower income demographics. You know, it's not necessarily an assumption that no, we can't get to these products and access them. In some cases, it is a conscious choice. It may or may not be an intelligent choice and a well-informed choice, but it is a conscious choice. So and if you're only using it occasionally, like you say, the landscape is different.
Certainly, I mean, I think there are reasons to be concerned about some of these fintech products, but reasons to be optimistic as well that they can be designed and offered in a way that, again, promotes financial health at the end of the day.
Great. Andrew Warren, Manager of Research for the Financial Health Network. Looking forward to, and I always, as I said, I always enjoy your research. I'm sure there's more good stuff coming up. This is part of an ongoing, the FinHealth Spend Survey? Is that an ongoing initiative?
Yes, it's part of our financial health spend research initiative, which really tracks how consumers are using and paying for financial products and services over time.
So you're doing that on an annual basis, right? Going out in the field?
Yes, yeah, that survey is on an annual basis. We write an annual report, but then we also occasionally release research kind of, diving deep into specific topics like this one.
And that's what this is. This is the deep dive on one specific thing that can be informed by that. So good stuff. I'll be watching as the next content comes out. Thank you so much. Always appreciate your time.
Thanks, Glenn. Thanks so much for having me.
See, I can't wait to hear more about this. I'm sure it's going to show up, whether it's literally on stage. If not, I'll just find somebody at the Emerge conference and dig in further into this one as well. I do have a discount code if anybody's interested. May 19th through 21st, the Emerge Financial Health Network conference taking place right in my backyard. I get to stay local for this one. So if you're so inclined, I've been there before. It's a good use of your time. It's a very interesting conference. Good credit union representation as well. It's a lot of the benefactors of the Financial Health Network tend to skew toward the largest banks, but the whole notion of financial empowerment, financial literacy, and inclusion, I think, are all topics that resonate quite well with this audience. So as I say, I've got a discount code there. Check our show notes. You'll find out more about that. We'll have more new content on the Big Cast next week, but I'm heading back onto the road. I've already got the interview for next week recorded, and more about that in a bit. But last week of April is a wild one. Smarter, Faster Payments, the NACHA conference, taking place out in San Diego. And then just a day, I think starting just one day later, out in Orlando, Florida, the NACUSO Reimagine conference. We have always done a lot with both of those. I plan to actually manage to hit both, connected by a red eye on Monday night between the two, and come back with hopefully a good bit of content to share with you after those. If you happen to be planning to attend either of those, please do reach out, whether in the conference app, on the LinkedIn page, at the Best Innovation Group. Would love to track you down, hear your thoughts. Again, my name is Glenn Sarvati. My firm is 154 Advisors, but I'm doing this on behalf of the Best Innovation Group, which, as I say, we continue to do very cool things with financial technology. And you can find out more about those things by visiting the website big-fintech.com. If you go to the media tab, you will find all of our past episodes, including the one covering CU Unplugged, which I mentioned just before. the one about the new group that is trying to advance the cause of small credit unions, and all kinds of other exciting stuff to keep you busy. And if you, for your commutes or dog walks or wherever else you listen to your podcast, and if you're so inclined, please do follow, subscribe, whatever you do on your platform of choice, Spotify, Amazon Music, Apple, whatever. And you'll be alerted when we have new content, which is usually every Tuesday. You can reach out to our Grand Poobah John Best as well. You can, again, the website or his LinkedIn profile is a good way to do that. And until we hear from you next, or until you hear from us next, always, thanks for listening.
Check back each week for the latest from the Big Cast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big FinTech. Email info@big-fintech.com or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.